And welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We got 1 hour to go until the market close, so let's take a look at the major averages. We've had a lot of whipsawing around today. Again, a fairly small range, but nonetheless, decent amount of volatility within that range. Up 87 points now on the Dow, but having taken a sharp leg downward in the past just few minutes or so. The S&P 500 down 0.2%, similar movement there, and the Nasdaq off about 0.5%.
I wonder how much is going on today, Julie, just about what's on deck coming up. I mean, we got inflation data today, PPI, but really, CPI tomorrow, that's in focus. So a lot of attention on that, and investors will look that over, try and deduce what the path of Fed rates could be ahead. And then also ahead, of course, earnings season.
Yeah.
It's here officially tomorrow, big banks.
Yeah, we had PPI wholesale inflation rising 0.2%. That a little bit milder than expected. But options traders looking at CPI are pricing in swings of as much 1% in either direction, depending on what we get from those numbers tomorrow morning. So perhaps some positioning ahead of that, to your point. Well, Yahoo Finance's Jennifer Schonberger is standing by with Securities and Exchange Commission Chairman Gary Gensler. Jen?
Thanks so much, Julie. Chair Gensler, thank you so much for sitting down with me and for granting me this exit interview.
Oh, Jennifer, it's good to be with you.
Monday, the SEC took action against Robinhood and a number of private equity firms in this country. With less than a week to go until your term is up, can we expect more action from the SEC?
Look, we are entrusted by the public to make sure that the capital markets work for them, investors, and ensure that people comply with the laws. And we have an important duty, and we're going to fulfill that duty all the way through, regardless of who the leadership is. This week and next week, there'll be different leadership, but we'll continue to make sure that the capital markets work for investors and market participants comply with the law.
So that's a yes.
Well, that's what we do. That's in essence, how do you build trust in capital markets? If not that, you follow the facts and the law without fear or favor. And in fact, the good faith actors in the market benefit from all that, because then more investors want to come into the markets and participate.
What do you think the next administration means for the SEC? And are you worried that what you've done over your term could be overturned by the next administration?
I think that what we've been able to accomplish in this administration has been very significant. Remember, we came into office, I came in right after the GameStop events, in the midst of a bunch of hype on SPACs. And we've put in place the most significant reforms in equity markets. I would say we got that through with our fellow commissioners, unanimous, bipartisan. We put in place very significant reforms in the treasury markets. I can't imagine anybody would want to go back to longer settlements. We shortened the settlement cycle to 1 day. I can't imagine anybody would want to take away from the public the first federal privacy notice, is that if your information gets hacked from an investment advisor or a broker-dealer, you're going to get a notice now. I just can't imagine somebody would want to sort of take that back. I dare say I don't think that they'd want to make it easier to allow insiders at companies to trade on material, non-public information. So I feel really good about what we've done. Of course, democracy has consequences. The next team could choose to take different directions, but I think these are good policies that lower cost and promote integrity in the capital markets.
Chair Gensler, some think that the crypto contingency helped Donald Trump win the last election, and that perhaps the policy approach, regulatory approach the SEC took surrounding crypto hurt Democrats in the last election. What do you say to that?
Look, I think that it's important to build trust in capital markets, that people comply with the laws as passed by Congress and that this great agency enforces. Think about this question. We have rules on the highways, and we have traffic lights, and we have cops on the beat. If you were driving a hybrid on the highway, should they not have to comply with the laws, or an electronic vehicle on the highway not comply with the laws? So we apply the laws across financial markets consistently, and the crypto field is non-compliant. Now, I would say this. I think voters are smart enough to know, and they were voting on other things, other pocketbook issues, whether that's around inflation or other issues, economic issues. I haven't seen any indication that crypto is what drove people one way or the other, given this great nation.
You accomplished a lot in your term. You talked about shortening settlement cycles, reforms to money market funds, the treasury market as well. But correct me if I'm wrong, you lost 4 of 5 challenges to your rules. That's more than the prior 3 chairs combined I have in my notes. Is there something that you would have wanted to have done differently?
Look, I think that this is an interesting time for anyone serving in government because the courts are changing quite a bit. And Wayne Gretzky, great hockey player, had this saying about that, and I won't quote exactly, but you want to play to where the puck is going, not where the puck is. The courts, in this analogy, is the puck. Where are the courts going? They're reinterpreting law, whether it's environmental law, communications law, health law, securities law. We've done everything within the law as Congress has adopted it. We worked on and completed 46 important rules for the capital markets, the vast majority of which have not only been adopted, but now implemented. So people are benefiting from knowing whether corporate executives are getting paid on erroneous financials and whether they have to claw back that information. As you said, reforms in the money market area, but also we, the SEC, are now able to get better information about private funds as well. So there's a lot that we've accomplished together. Half of our rules, by the way, were voted on with some bipartisanship, with my fellow commissioners, Republicans, voting on it. But yes, I would have preferred not to have had those setbacks in the courts, usually down in Texas in the Fifth Circuit. I think, though we advanced the discussion of artificial intelligence and the use of artificial intelligence in finance, I would have liked to have made more progress because I think as good as artificial intelligence is, I think it's promoting productivity. I think it's building access. I think we're basically, automating our minds when in the past we automated our biceps and our thighs. But in automating one's mind, we can also see some consequential things that I think we're going to need to address.
I do want to come back to AI, but before that, you have repeatedly warned about the dangers of crypto. And your hand was forced a bit by the courts, speaking of the courts, over the past year to approve spot Bitcoin and Ether ETFs, opening up crypto to the masses for investing. Do you wish that there had been a different outcome, and are investors at greater risk as a result?
I think that investors actually in Bitcoin, which is not a security, my predecessor, we've never said Bitcoin's a security. We haven't said Ethereum is a security. I think investors in Bitcoin and Ethereum, the masses, as you said, had access to these prior to the exchange-traded funds and products. We approved under my watch an exchange-traded fund for Bitcoin back in 2021. It was just this so-called spot exchange-traded product that was later. I think investors actually got better protections with the exchange-traded product. Lower fees, much lower fees, surveillance by the stock exchanges, disclosure in disclosure. They were registered products with the SEC, these exchange-traded products. My predecessor had denied them. We followed Jay Clayton's leadership on that. That's over 70, maybe 80% of the crypto market is related to Bitcoin and Ethereum. I really take a look at the other part, these 10 or 15,000 other tokens, which can only really persist because investors are investing in essence, betting on a project. They need the proper disclosure. The law says you're supposed to get that disclosure, and they're not currently compliant without prejudging any one of them.
A couple follow-ups there. First, you just said that Bitcoin and Ethereum are not securities.
I said that we, the SEC, have never said they're securities. I just want to be careful exact words.
Okay, so why won't you just come out and say that they're not securities or they are securities?
Because of the nature of my job, I always try to be as careful as I can with the language. But I would note, again, without prejudging any, investors who are betting on the future are betting on a lot of these tokens. And think about it in finance. Everything in finance has a mixture of fundamentals and sentiment. And before we went on air, we were talking a little bit about Warren Buffett and Charlie Munger and how Charlie used to talk about this crypto field, and he referred to small rodents when he talked about this field. And that was Charlie, and he was a wonderful investor. You need fundamentals ultimately. Momentum can only carry you so far. And so I think for any investor listening, you really want to think through. These are not only highly speculative, but on thousands and thousands of projects, you have to question what is their true use case? What is their value proposition?
The crypto industry repeatedly called for customized rules for digital assets. You said the SEC's got rules on the books. The crypto industry said the SEC regulated through enforcement.
Look, I'm sorry to interrupt, but if you went on a highway and you're driving a hybrid and you said, well, there's no laws because the laws weren't written for hybrids, that's just not, that doesn't cut it.
But Chair Gensler, the incoming administration does favor customized rules for digital assets. So come January 21st, and by the way, now we have majorities in both houses of Congress with Republicans. We could see Fit 21 come back. How would you see that? How would you see customized rules for digital assets for crypto?
I see that as a part of our great democracy, that the policymakers
but you still
will
wouldn't
change
favor it
from time to time. I'm gonna let the next team make their own decisions, Jennifer, and leave them room to make those decisions. But I do think that the public truly benefits from this 90-year regime. What we have done at the SEC is helped promote economic activity and trust in our capital markets. And we've done that in so many ways. We've done that in new disclosure regimes for material disclosure, for cyber and climate and the like, where investors get the information that they're demanding, material information they need. Right now in crypto, not happening. And just think about the tens of billions of dollars of losses and the key leaders from this field in crypto that are now in jail that misled the public, and the number of bankruptcies. So a non-compliant field is not really going to persist because the investing public will get hurt.
Not to put too fine a point on this, but a federal appeals court said on Monday that the SEC needs to better explain why it turned down a request from the company Coinbase to develop rules for crypto. So the companies were coming in asking questions about specific rules and felt that they were in the dark. So while you say there were a highway needs rules of the road, crypto felt they didn't have it under your leadership.
Not liking the law and not liking the rules doesn't mean there aren't laws and rules. And with all respect, this is a worldwide field, many jurisdictions and so forth. But the laws and the rules here in the US, whether they're anti-money laundering, whether they're sanctions regimes, whether they're the Commodity Exchange Act, whether there's securities laws, many in the crypto field are not complying with our time-tested laws.
Continuing with Coinbase, the company was just recently approved to move forward with an appeal. I know there's been a lot of litigation. The judge said specifically in the order that the court finds there is substantial ground for difference of opinion between conflicting authority and that it exists regarding the Howey's application to crypto assets. The court agrees with Coinbase that the conflict between Ripple on the one hand and Terraform and the order on the other is symptomatic of the more fundamental difficulty of applying Howey to crypto transactions. What do you say to that?
So Jennifer, I'm speaking directly to your viewers. You'd have to understand, we're not going to speak to litigated matters here in an interview like this. We speak to the judges that are appointed, and we do this at proper filings in front of the court.
Fair. President-elect has talked about a Bitcoin reserve. Senator Cynthia Lummis has also put that in some legislation. What do you make of that?
Look, I think central bank policy and the Federal Reserve here in the U.S. Are really critical to the importance of our economy. And I think in essence it's backed by central banks ultimately, and their balance sheet are backed by their governments, not by putting some digital asset in their reserves. And they participate in the capital markets in very important ways in trying to fulfill their dual mission. I'll leave it to the central bank to speak to these matters on their own. But I think that it's not how any central bank around the globe has traditionally thought about how to conduct monetary policy.
Chair Gensler, you mentioned AI early in this interview, and last year you said it could be a potential source for future financial crises. You said you would have done more on that front. What are the vulnerabilities right now when it comes to AI?
So I think artificial intelligence for the last 10 or 12 years, even before the generative AI wave, had already started to boost productivity as we were automating that which goes on here. I think this is accelerating. It's changing finance in many ways. I think as policymakers, we have to think through a number of things. Really importantly, the conflicts. If the algorithm is doing something, is the algorithm doing it for the investor or for the broker-dealer or investment advisor? Are they still sort of maintaining their fiduciary standards in the algorithm? Number two, fraud is fraud. And what if the algorithm is doing something that defrauds the public, and particularly if it's just deployed? And so then we talk in the law about a state of mind or scienter. Well, I think if you deploy a model, you still should have responsibility to have guardrails about the model. These are really important factors. But lastly, finance tends towards concentration. Technology companies also tend towards concentration. I foresee in the future, a likely future, that there's 2 or 3 big consequential base models. And then what happens if the whole of finance, banking, insurance, brokers are all relying on some base model? That can lead to real fragility. It's called a monoculture, when everybody's relying on one party. I like to quote this movie, Her, when Scarlett Johansson plays the virtual assistant, and she actually has 8,316 lovers, virtually. And then she goes offline, and they're all lovesick. What happens if 8,316 banks, broker-dealers, investment advisors are all lovesick when Scarlett Johansson, Amazon or Microsoft or OpenAI go offline maybe? That's, I think, and it's not an easy problem to solve.
Before I let you go, do you think the Treasury market can withstand a next financial crisis?
Look, our U.S. Treasury markets are very deep, very liquid. They're about $28 trillion. The Congressional Budget Office estimates that just in the next 4 years, in the next administration, that it will grow to 35 or 36 trillion, and that's before Congress might do things to make that deficits even larger. I think, so that's $7 or $8 trillion more, 25, 30% increase in Treasury market. I think a number of the policies being debated right now also could be directionally put upward pressure on inflation, whether it's tax policy, tariff policy, immigration policy. It's been well discussed and debated. So I think that's why it's so critical, the reforms that we did in a bipartisan way, working with Jay Powell and Janet Yellen's Treasury and the Federal Reserve, that they get implemented over these next 18 months to kind of lower the risk in this Treasury market. There's going to be a flood of more supply, more Treasuries to be sold, and fragility in that market could come also from, there's a lot of leverage in the system, leverage borrowing, with big hedge funds borrowing from the big banks through prime brokerage relationships. And about half of this, what's called repurchase market, measured in the trillions of dollars, is right now a risk in the system, especially if there's some geopolitical shock or some economic shock. And the shock could come outside of the hedge fund community, outside of the banking community. But if that outside shock comes and the banks and hedge funds want to lower the risk, what's called deleverage, take risk off the page, then you can see that kind of accelerate.
Chair Gensler, I want to thank you so much for your insight today and for all of the interviews that you've granted me over your term here. And congratulations on the past 4 years, and best of luck to you.
Well, thank you so much. I think I'm so proud, if I can just say, of this great agency. The public servants here at this agency are thinking about everyday investors in stocks, in bonds, in money market funds, in mutual funds, and just trying to make sure that they have a better life and that we have their back. And yes, that folks comply with the laws, whether they're driving traditional cars, hybrids, EVs, whether it's bonds, stocks, or crypto securities. So thank you, Jennifer.
Thank you, Chair Gensler. Guys, I'll send it back to you in New York.
All right, thank you, Jennifer. And joining us now to react to Jennifer Schonberger's exit interview with SEC Chair Gary Gensler is Ann Lipton, Tulane University Professor of Business Law and Entrepreneurship. Ann, it is good to see you. So you were listening to that interview, Ann. I'm curious to hear what you made of it. What were the highlights, Ann?
Well, I have to say I completely agree with Chair Gensler when he said that a lot of his rules followed what he thought was existing law, and then the Fifth Circuit, which is very entrepreneurial about these things, struck them down. So some of the more ambitious changes that he made, some of those were struck down. Others, Clay mentioned the climate change rules. Well, the climate change rules, they're not in effect because they were placed on hold because they were challenged. And I think the new incoming administration is likely to no longer to defend them and to sort of unwind them. So unfortunately, those, which would have been one of the more dramatic undertakings of his SEC, is unlikely to go into effect. And of course, crypto policy is likely to change rather dramatically. So a lot of his efforts, unfortunately, are going to be undone, I think, in the next few years.
And it's Julie here. Undone perhaps, not just by this incoming administration, but to your point, what we've seen from the courts. And I thought it was interesting that he sort of blamed the Fifth Circuit to some degree, right? He said the courts are changing. Do you think we have, as somebody who watches this kind of thing, have we seen a more, not just in Texas, but have we seen a more nationwide shift in the way that courts are ruling on securities law?
Yeah, I mean, I think actually just in tech, I mean, but the difficulty here is that, the business groups that are challenging the rules, they understand that the Fifth Circuit is very sympathetic to their argument, so they bring the cases in the Fifth Circuit. So there isn't as much weighing in from other circuits as there is. The Fifth Circuit has become the most active for some of this stuff. They're, of course, taking their cues from the Supreme Court to some extent. The Supreme Court has obviously become more conservative. It has constrained what administrative agencies, including the SEC, can do, but the Supreme Court hasn't gotten hold of a lot of these rules because they've been blocked at the Fifth Circuit and they haven't gotten to the Supreme Court.
And the crypto industry wants customized rules. That came up in the interview. Gensler said, listen, I'm going to let the new team handle that. I'm curious, is that coming in, and what do you think those customized rules could actually look like?
Okay, yeah, I think that that's sort of inevitable. And so there are a couple of different things that are on the table, although I don't think it's all going to come from the SEC. I think it's very likely that some of this will be handled through legislation through Congress. But I mean, there are two sets of issues. So the first is whether crypto even is a security. And some proposals would still make some crypto a security, but create some fairly bright line rules as to when it is and when it isn't. And then even when it is a security, I think what the crypto industry is asking for, and they're very likely to get, are a different set of disclosure requirements that are more tailored to the nature of crypto, how it operates, and the kinds of operations it is. So they complain, not without reason, that some of the existing disclosure requirements that are designed for ordinary corporations with ordinary income and profit and loss statements really don't make a whole lot of sense for a crypto project, which has different concerns and doesn't have ordinary financial statements or even necessarily a street address.
Yeah, obviously a lot to consider there. You're a professor, obviously. When you look at the Gary Gensler era at the SEC, how do you think that's going to be taught in sort of securities law history classes?
Well, I mean, the thing is that, in a securities law class, you have a very limited amount of time to teach anything, and you mostly teach the current set of rules and maybe a little bit of background as to how we got to where the rules were. So unfortunately, to the extent that a lot of the more ambitious undertakings of this SEC are, undone by the courts, they're simply not going to be in the SecReg casebook at all. Maybe some of the case law that adopted a new and more, rigorous oversight of the SEC, maybe that case law may make it into the casebook to essentially show new constraints on the SEC's rulemaking powers.
Interesting if that indeed ends up being the legacy. Anne, thank you so much for your time. Appreciate it.
Glad to be here.
Let's get a quick check on stocks here. We're still seeing a mixed picture as we count down to the closing bell, with the S&P and the Nasdaq in the red, the Dow still in the green here. But again, there's been a lot of fluctuating within a range today. We're going to keep talking about it, check out some stocks to watch, and talk about how to play it. Stick around, much more market domination still to come. Stocks are mixed as investors took in the first of two key inflation reports this week. U.S. stocks have retreated so far this year. Our next guest, though, says there's one aspect needed to be taken into account for the stock market. ProShares global investment strategist Simeon Hyman is joining us now to discuss. And I love this. You say there has been rational exuberance in the market, although I guess some of that exuberance has come out as of late.
A smidge, and we'll get to that, but I guess I'll defend my rational exuberance for starters with something I think that has gone unnoticed, and that is that the S&P 500 is substantially less leveraged than it was 20 years ago, to the tune of about 1/3 to 1/4 of the leverage that was there 20 years ago. Now, that in and of itself says the market's a little de-risked. But what it really specifically points to is the underlying profitability. People look at return on earnings, and it's only a little bit better than it was 20 years ago. But because you're getting there with a fraction of the leverage, it means that the underlying profitability, the return on assets, are 4 times what they were 20 years ago.
Does it also imply that the reaction that we've seen in stocks to a rising bond yield is perhaps misplaced? In other words, you know, traditionally, if a company had a lot of leverage, or if investors had a lot of leverage and those rates went up, they would get squeezed and their costs would go up. But if they're not as leveraged, then that's not really happening. Or do you think that's not really?
I think what's happening now with regards to the impact of the bond market on the stock market is pretty much textbook. In other words, Powell said we're not going to get to 2%, we're going to get to 2.5%. And lo and behold, the entire yield curve in parallel goes up 50 basis points. There we go. That 50 basis points, it's worth about a turn on earnings. Well, we were at 25 times, so one turn's about 4%. There you go. But what I do think is important is get away from the week or two or the month of reacting to that. What's the best solution and antidote to inflation? It's earnings growth. Bonds have a fixed coupon. We're down maybe 4% from that one turn. All we need is some earnings growth and you'll overcome it.
Let me ask you, just getting back to rational exuberance, what are the metrics you watch that would indicate to you, okay, we've moved from rational to irrational?
Look, 25 times is stretching it a little bit, but I think it can be defended on the basis of stronger underlying profitability. But if you saw 30 times, then it's hard to defend even from that perspective of stronger underlying profitability.
We're looking at stocks today that are trading a little weird, for lack of a better word, right? We've got a lot of sort of volatility in this range over the past couple of days. Is that just a function of people looking ahead to CPI and feeling a little bit of nervousness around what that could show?
Yeah, and I think it's policy uncertainty too. We just don't know exactly what's going to happen. There's certainly some stuff on the bullish side. Deregulation, lower taxes, expansionary fiscal policy, all to the good. Of course, people worried about tariffs on the other side. From our perspective, one of the most bullish signs is how thin the majority is in Washington right now, because historically it hasn't been Democrats or Republican regimes that have been best performing. It's gridlock.
Right.
Now we don't have gridlock, but it's pretty thin, so the chances of extreme policy changes, that's what markets don't like, are at least diminished somewhat because it's so thin.
Not gridlock, but heavy traffic.
Heavy traffic, yes.
Actually, the 10-year keep trucking higher. I think we're just under 4.8 here. Can it keep moving higher and stocks also move higher, or it depends why they're moving higher?
I think the math here on the 10-year is pretty straightforward. You got 2 to 2.5% real yield on the 10-year on average historically. So because when the market seemed to be pricing in the 2% landing, okay, we're 4 to 4.5, and now we're pricing in 2.5% landing. Okay, that's 4.5 to 5. What I suggested was that was worth about maybe 1 multiple lower on PEs, and if we got past 5, you could see another 1 multiple tick down. But I don't see 5% as some magic psychological inflection point, if you will.
You guys at ProShares have a suite of different ETFs, and I know that in this environment right now, you're looking in particular at a high-income ETF that you guys offer. In other words, a dividend-paying ETF. Is that a way to think about it?
This guy's a little bit different.
Okay.
So our flagship ticker in our high-income suite is ticker ISPY or iSPY. And it's a covered call strategy, but an innovative one. This is an environment where, number one, income unrelated to interest rates is important because you've got the inflationary pressure on the bonds. And there's a little bit more volatility in the equity markets, so folks will say, hey, I should write calls right now because I'm going to get more premium. Here's the challenge. a traditional covered call strategy where you write calls every month, you decimate your ability to participate in the S&P 500. What we've done with iSpy is it's a covered call strategy that uses daily options. A lot of press on those, but they're super great to deploy in a covered call strategy because you can get all that income, but you can get full participation in the S&P 500. We think that's a nice place to be because we like stocks a little better than bonds, but folks still need some income. Here's a way to get income, but participate in equities.
Gotcha. Simeon, good to see you. Thanks for coming in.
Thanks for having me.
Well, the annual ICR conference, bringing into view a better understanding of consumer trends. Yahoo Finance's Brooke DePalma joins us now with some top takeaways. You've been at the conference, so what have you been hearing, Brooke?
Well, good afternoon from sunny Orlando, Florida. Certainly nice to be down here in a little bit of heat. What we're hearing is really this continuation of trends that we saw in 2024. This idea of a strong U.S. consumer that needs to be convinced to buy. And with that, it really kicked out of the gate yesterday morning on Monday with results from companies like Lululemon, Abercrombie & Fitch, and American Eagle, where we saw these strong holiday numbers. But the thing is here is that investors had already anticipated that. We heard from companies like Adobe, as well as the National Retail Federation, that consumers were spending this holiday. But what really spooked investors here is that cautious profit outlook, most companies holding off from raising their profit guidance. And that's largely what experts are telling me was that amid this uncertainty of how exactly this year will play out. Now, I did mention earlier that they need to be convinced to buy, and they'll do this with newness and innovation. Nothing really new there, but really this re-emphasis of it post-COVID. Some and many calling it the year of color, the year of new products. So certainly keep a lookout for that, these new products coming to market in order to convince consumers to buy. And while not mentioned on the main stage here at the ICR conference, lingering in the background a bit is what could happen next week with those potential tariffs under President-elect Trump as soon as even Monday night. Some experts and some C-suite executives that I've been speaking to is that they really don't know what's going to happen, but they feel like they are better hedged against it following the previous Trump administration, many saying that eventually that cost will have to trickle down to the consumer.
All right, Brooke. Thank you so much. Enjoy Florida. Stick around. Much more market domination right coming up ahead. JP Morgan announcing that Chief Operating Officer, here we go. There we go. And longtime number 2 to CEO Jamie Dimon will step down from his role in June. The move setting off a C-suite shuffle with implications for Dimon's successor. For more, now bringing in William Cohen, founding partner at Puck. William, it's good to see you as always. You know the drill. When we get headlines like this, the immediate question is very interesting. What does it mean for succession at JP Morgan? What does it mean, Bill?
You know, I don't think it means a whole lot, to be honest, because I don't think Jamie Dimon really wants to go anywhere. I don't know if you watched the interview Leslie Stahl did, CBS Sunday Morning 2 days ago. He looked like a man who was very comfortable, wasn't anxious to go anywhere, wasn't giving any indication whatsoever that he had chosen a successor. Said that even when he does turn over the reins of CEO, he intends to be chairman of the board still and stick around and have influence.
That's just what his successor wants to hear.
Just what a successor wants to hear. You know, it has sort of like Bob Iger-like implications and overtones. So I don't think Jamie's going anywhere. He seems to be in good health. The company is absolutely a juggernaut. I mean, I think they're about to report something like $12 billion in fourth quarter net income, which would put them on a plus in excess of $50 billion for the year of net income. That's extraordinary. It's extraordinary.
So, but when you're looking at these situations on Wall Street, how problematic? You know, there's always a lot of talk about that they should have this succession planning.
It's the most important thing they do.
Well, so you know, is it a problem for recruiting and retention of some of their higher, Daniel Pinto leaving? And is it a problem for investors? Like Jamie Dimon, is not going to live forever. And there have been health issues in the past, relatively distant past at this point. But nonetheless, God forbid something happens. If you're an investor, is the bench enough? Is the succession enough? Are things clear?
Look, it's, as I said, it's the most important job he's got. Yes, it's very important that he, solved the bank's problems, turned the bank around from when I was there. It's, as I said, it's a juggernaut now, but he's not going to live forever. He's 68, I think. So, I mean, the board isn't probably going to want him to leave. He's incented to stay till next to 2026. I'm sure they'll figure out a way to extend that, but he's got to find somebody, kind of anoint them, let them have a chance to run a little bit without his oversight, just like James Gorman did at Morgan Stanley and Lloyd Blankfein did at Goldman Sachs. This is what Jamie needs to do. And by the way, if you get it wrong, as I wrote about in my book about GE, when Jack Welch chose Jeff Immelt, which turned out to be the wrong choice, it can have huge and grave consequences. So it's a hugely important decision. There are obviously a lot of good candidates. I assume there are good candidates inside the firm, and there are probably good candidates outside the firm. Don't forget, Jamie Dimon came from outside the firm. So, being inside the firm doesn't necessarily mean anything at this point. And I'm not sure that there's anyone inside the firm. Clearly, there's not anyone inside the firm who has the stature of Jamie Dimon. Are there people outside the firm that have the stature of Jamie Dimon? Closer, but probably, he's a unique individual at this point. So, this is essential. This is hugely important, and frankly, hasn't done a very good job about it yet.
So, Bill, so Jamie Dimon, he may be on the downslope to 70, but as you said, he looks comfortable. Bank's firing on all cylinders. But if you had to place a bet, who do you think would be next in line?
I think it's going to be somebody from the outside.
You do?
I really do. I don't think there's anybody inside the firm that with all due respect to Marianne Lake, who's sort of the leading candidate at this point, I don't think she is likely to get it.
Why, Bill?
Well, I don't, investment banking is such an important part of that firm at this point, even though Jamie has told me that, 80% of their profits are kind of locked in year in and year out, with the variable being the investment banking business. She did have a stint in investment banking, but, But of course, Jamie didn't work in any of the businesses that are now central to J.P. Morgan Chase. He was, in the executive office working with Sandy Weil, right? So, I'm not saying it's not possible. I'm not saying it's, not going to happen. But I just feel like, it's really important to get someone of stature. This is our biggest bank. It's got a market cap over $500 billion at this point. It's on its way to $1 trillion probably. And to get to that next level, you need a serious person who can lead the firm and inspire the troops and get them all continuing to paddle in the same direction.
Yeah, so not making a choice is the wrong choice, but you don't want to make the wrong choice.
And a lot of talent has left J.P. Morgan Chase
Right.
because Jamie has not chosen a successor.
Yeah, I want to turn to something else that involves executives, and that is next Monday in the inauguration, and all of the tech executives who are now expected to be there, including Elon Musk, obviously. I mean, he's practically living.
He lives in Mar-a-Lago at the moment.
You've got Mark Zuckerberg, you've got Jeff Bezos. What do you make of this sort of shift that we have seen in corporate America?
Yeah, it's pretty ugly to watch. It's not surprising because, these guys have to genuflect in the direction of power because they're sort of in the crosshairs of government, potential antitrust lawsuits. If they want to do deals, they have to be on the right side of these individuals. And, the winds have changed considerably. I'm sure many of them thought that Donald Trump would never return to the White House. And it was okay to be critical of him, on the way out.
Well, but Bill, if I may,
Yes.
How much of this is, I think you could view it crassly. I mean, Zuckerberg has sort of framed it as this is his true self. This is what he actually thinks. And he was being political before, but now this is really, Elon Musk, it seems clear that ideologically he is aligned. So
I think they're just doing what is politically expedient for them and for their companies. I don't think this is who Mark Zuckerberg really is. Maybe it's who he pretends to be. Elon Musk was a Democrat once. Now he's this right-wing, lunatic. So I think they're, to get along, to go along, to get along, you have to go along. And I think that's what they're doing at this point. And it's expedient for them. It's expedient for their companies. It doesn't make them look good. They're not showing much spine or backbone, and it may backfire. He may, choose to go after them regardless of the fact that they're sucking up to him mercilessly at this point.
His relationship with big tech is kind of complicated, Bill, because sometimes he says nice things, but a lot of times he doesn't. Do you think this parade of American tech execs going down there, whether it's Bezos or Zuck, Musk, do you think they can not just curry favor, but also do you think there's a possibility they can change his mind, soften his opinion when it comes to big American tech, or no?
I think Donald Trump is going to do what Donald Trump wants to do at whatever particular moment he's presented with a decision. Right? He said what, a couple of weeks ago, nobody liked me in the first term. Now everybody likes me. Everybody wants to be around me. His ego apparently is so fragile that he's looking for, support from these people. I'm sure he's loving it.
Well, he might be just as, maybe he's just as surprised, but I can't believe what's going on today, this parade that comes to see me versus what was going on in 2016, 2017.
I'm sure he is quite surprised by it. But, in the end, he's going to do whatever he feels he wants to do, regardless of whether, they've been genuflecting in his direction for, a few weeks. Yeah.
We'll see what happens. Bill, it's great to see you. Thanks for coming in.
My pleasure. Thank you.
Coming up, Signet Jewelers sinking today after cutting its full-year outlook. We'll take a look at some of today's top trending tickers on the other side. Now it's time for some of today's trending tickers sponsored by Tasty Trade. You can scan the QR code below to check out the best and worst and most traffic stocks of the session on Yahoo Finance's trending tickers page. First up, we got to look at Signet Jewelers. Those shares sinking and how as the company slashed its full year and fourth quarter outlook. The company says fourth quarter comp sales will still grow by 2 to 2.5%, but it will drop 2% to rise 2.5%, which is worse than its forecast was before.
Yeah, and this comes after, by the way, we talked about this with Julie. You know, we heard from other retailers. It was Macy's, this is Abercrombie & Fitch also offering disappointing holiday sales. This one, though, today, I mean, just to put a point on it, biggest intraday decline since June 2020 for this name, and it has been just crushed. It's down about 40% over the past 12 months, and even so, you know, sometimes you see a move like that, analysts will move in. They'll think, well, the bad news is priced in. I mean, this one is still dividing line on the street. 4 buys, 4 holds, 1 sell.
Yeah, and just got a new CEO in November. J.K. Symancyk joined it from PetSmart, taking it from longtime CEO Gina Drosos. And he talked about trying to turn the company around at that point to reshape our customer-facing strategies, is what he said in the statement announcing today's numbers. But it just doesn't seem to be working. I mean, you look at the history there of the same-store sales, hasn't had a same-store sales growth going back several years. So this is what the company is up against.
Yeah,
here.
company saying holiday same-store sales results reflected peak selling days leading up to Christmas that were below forecast.
Yeah.
Taking a look, meanwhile, at shares of Boeing as the aerospace manufacturer reports a decline from the year prior in aircraft deliveries. And Yahoo Finance's Praz Subramanian joins us now to discuss. Praz.
Yeah, Josh, sort of reflects a tough year that Boeing had in 2024. Deliveries at 348 for the year, down a third from a year ago. Meanwhile, Airbus hit 766 jets delivered, so almost double what Boeing did. So you know why? It all stems down to that door plug blowout we had in January of last year, causing all kinds of production stoppages. And there was a strike later in the year that basically makes it harder for a big company like Boeing to restart production of these massive planes. The good news is Boeing did deliver 30 planes in December, as it did ramp up 737 production. So there is some glimmer of hope there, but a big year for Boeing ahead, and they have earnings coming up later this month.
Let's also talk about another kind of vehicle that you cover closely, and that's EVs. And maybe I'm too US-centric, and that's why I didn't realize, but EV sales actually rose last year, and they rose by a decent amount.
Yeah, 25% according to Row Motion, which is a battery and EV data tracker, driven mostly by China, right? 40% growth in China to 11 million units, based off 17.1 total in the whole globe. So China really driving a lot of that there. They have a lot of good incentives there with trade-in programs and other types of things that they're doing to boost those incentives. But also, it's big for Tesla. They sold, apparently a different report showed they sold the most Model Ys, or most cars. Sorry, the most popular car in China is the Model Y, believe it or not.
The most popular car, period, or popular EV?
EV is Model Y. More popular cars in China are these plug-in hybrids, things like that. But also, on the first day, they had new Model Y pre-orders. They had 50,000 of those in one day. So it kind of shows you, how much enthusiasm there is for Tesla cars in China, but also how big it is and how much of an opportunity it is for them. So that's a big deal there for them. Turning to US and US and Canada, about 9% growth. Steady, around 8 to 10% usually is pretty common for the US, but those numbers are under threat if Trump gets rid of the federal EV tax credit. That's a big deal that the report writers mentioned as well.
All right. We'll see. Praz, thank you.
Thank you.
Appreciate it. And while wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickry to get you up to speed on the action from today's session. First, I'll take a look at where the major averages ended the day. As we've been talking about all day, just a lot of bouncing around today. We saw this kind of action yesterday too. A lot of volatility in a relatively narrow range, but the Dow, after taking a leg downward last hour, kind of coming back up here, ending the day higher by 220 points, about 0.5%. The S&P 500 ending in the green, just a little bit of a leg up at the end of the day there, up 0.1%. The Nasdaq not quite making it, although kind of making an approach in that direction, still down about 0.25%. We've been talking about people trying to position ahead of tomorrow morning's CPI report, not to mention the earnings. And as Simeon Hyman of ProShares talked about with us earlier, there's also the policy uncertainty that is looming with the inauguration on Monday. So all of that to consider. Jared, what are you watching today?
You know, I've been tracing out this head and shoulders pattern, and I'm not going to spend a lot of time on it. I'm going to do it with Josh in a little bit, but we're looking somewhat constructive here, and I'm not going to say that we're throwing in the towel on the bearish case. We still got to see what happens with CPI tomorrow. I think that's the bottom line. I've been focusing on the dollar and also the 10-year T-note yield. That was just down, the 10-year T-note yield down by about 1 basis point today, so not a lot of incremental action there. But I've also been watching volatility. Now the VIX, and let's get the actual VIX. There we go, down to 19.12, and you can see it was around 20, hit about 22 yesterday, but it has been trending up. That's what we're watching. Also, the ICE B of A Move Index, that's kind of like the VIX for the bond market, that has been trending up as well. And so as we head into this CPI day, along with bank earnings, we really have the market on a razor's edge, setting up for the inauguration and the few weeks beyond, and that's kind of how the thinking is. So I will go to our sector action for the day, and it was a day in favor of the cyclicals. And here we have utility. Well, utilities is not a cyclical. I'll grant you that, although with the AI trade, it's interestingly kind of melded with tech. But utilities took the lead. But then we have materials. That was up almost 1.3%. Financials, industrials, energy, and also real estate and tech. All of those were outperforming the S&P 500, which I'm circling here. What didn't do well was healthcare. That's XLV, communication services, consumer discretionary, and also consumer staples. So the defensive sectors didn't do as well as some of the more cyclical ones, and also add tech and growth into that. And that was a bullishly constructive day, although you don't see that in the mega caps here, do you? The Nasdaq 100 looking a little bit bearish with some respect to some of the bigger names here. Nvidia down 1%, Meta down 2%, Tesla somewhere there in between. But on an equal weighted basis, you can see more green than red. Josh?
Thank you, Jared. Rocket day on Wall Street as investors wait for tomorrow's CPI data. And even though the major averages are off all-time highs, our next guest says you need to take a look at valuations. Joining us now is Jim Masturzo, Research Affiliates CIO of Multi-Asset Strategies. Jim, good to have you on the show. So your message to investors, one message is, Jim, don't throw the baby out with the bathwater. What is the baby here, Jim? Walk us through it.
Yeah, well, thanks for having me. So, you know, what we've seen over the last 2 years in particular, you know, S&P, over 20% returns. And now we're talking about tech everything, AI in particular. AI is going to take over the world. And nobody cares about valuations anymore. This is akin to the tech bubble, in the 90s. And so our point is valuations still matter. Yes, the US market has continued to get more expensive, even though valuations are stretched. But if we look even beyond the US market into the global markets, valuations matter. Don't throw that baby out just because AI and tech are going to take over the world.
So valuation-wise, there's obviously been a lot of talk about valuations, but there's also been the idea that instead of getting sort of just multiple expansion this year, that earnings growth is going to be able to underpin some of the expansion that we'll see. What do you make of that argument?
I think that argument is what always comes up when we talk about valuations being stretched and we need a reason for continued growth in the market. We've seen over the last year, the majority of earnings have come from the mega caps, the Mag 7 or the Fabulous 4 or whatever you want to call them. And so what happens with the other 493? Could we see expansion? Sure. But at some point, investors are going to stop wanting to pay 30 plus Cape points for earnings. So we just see a lot of risk in the U.S. market right now, just given valuations.
We're always taught, though, also, Jim, as investors, valuation, it's always emphasized, is a bad timing tool. Sentiment and positioning can be more useful near term. I mean, what are you seeing there?
It's absolutely true that what we normally see are valuations grind higher over many, many years, and then they fall like a rock. And we saw this in 2020 most recently, where things normalize very quickly. And that's actually the biggest risk, is that, yes, could we continue to grind higher? Sure. But when valuations hit, they turn on a dime, and you don't want to be wrong positioned when that dime happens.
What are the contenders for causing that? What are the triggers?
Sure. I mean, we've got policy uncertainty, obviously, being one thing. The effect of China, obviously, China's slowing down, China's property market, what that does to the global, just global capital markets in general. Not to mention all the other geopolitical risks and everything else that now comes to fruition and has been occurring over a number of years. But now we throw in, and this is not just the US election, there's obviously elections going on, coming up in Germany and other parts of Europe, shifts more to the right from maybe the center and where we've been historically. And so you throw all that into the pot. We're not sure what exactly is going to boil over from where, but the overall volatility in markets just feels more uncomfortable now than it did, 6 months ago, a year ago. This is not to say that all of a sudden, recession is going to happen or things are going to, explode in the near term, but we're starting to feel more discomfort, more uncertainty as we move forward.
So, Jim, we were talking about how valuation is not attractive here. What about overseas, Jim? Would you see more relatively attractive valuations, let's say internationally, emerging markets?
Absolutely. And emerging markets in particular have been cheap for quite some time. The multiples are far, far less. And when we talk about this, it's important to say that in no way, shape, or form are we saying that emerging markets with their risk profile should trade at the same multiple as the US. But when we think about it, and we then tend to look at the CAPE ratio, the cyclically adjusted PE, the US trading at about 38, many emerging markets trading closer to 10. There's opportunities in, say, South America, Brazil, Chile, Colombia, for example. Now, that's not to say that near term there aren't risks there. There's a fiscal situation bubbling up in Brazil, which means Brazil might end up being cheaper in the short term. But as we look at those countries, we say, well, look, if you're trading at an 8 relative to a 10 or 11 on average, well, sure, that's a much cheaper opportunity to get in than you see in the US. Not to mention the dollar impacts. The dollar has been strengthening for quite some time, well over a decade. That's really long in currency cycles. Those usually last about 8 years. And so we could see an additional tailwind from a declining dollar. That might take a little bit longer. Obviously, policies, tariffs, and things like that could push the dollar even a little bit higher over the short term. But over the multi-year term, we see a tailwind from a weakening dollar.
So walk me through why you think the dollar is going to end up declining, because it would seem like a lot of the policies of the incoming administration would push it in the opposite direction.
Sure. So over the short term, completely agree with you that the policies, tariffs in particular, pushing the dollar higher, right? But the dollar is already stretched from a value perspective. It's been normally what we see in these cycles is that currencies tend to, which are actually very cyclical assets, currencies tend to appreciate on average for about 8 years. That's historically if we look at the cycles. Well, this cycle's lasted about 12 years. We obviously saw, dollar relative to yen, for instance. We're pushing back towards 160. That needs to pull back a little bit. That strengthening of the dollar for too long causes lots of fiscal issues in international markets and emerging markets and hard currency debt. So what ends up happening is that there just needs to be this push-pull animal that takes over. Yeah.
Jim, thanks a lot. Appreciate it.
Thank you.
Now let's get to some calls of the day. Bernstein making Robinhood its new best idea in its global digital assets coverage. The firm also maintaining outperform on the stock. Gautam Jagani, the analyst over there, and he's been sort of a bull on the digital asset universe more broadly here, but he likes Robinhood best. And a lot of this has to do with the regulatory environment. He points out that Robinhood, in comparison with Coinbase, just has a lot fewer, although it's exposed in crypto, has fewer crypto offerings, has fewer coins, for example, because it was more concerned with following the rules, I guess, than Coinbase is one way to put it. And now that the regulatory regime is probably going to change, he expects a lot more offerings from Hood.
Yeah, says, listen, I mean, acknowledging the stock has enjoyed a big run, but says to his clients, we see more upside as strong revenue growth is set to continue to drive profitability in 2025. Talks about seeing several catalysts for the stock in 25. Primarily, he says, to your point, Julie, crypto-related, including new tokens on its primary platform. By the way, Bloomberg, Morgan Stanley chime in too. They add the company to its financials finest list.
Oh, wow.
Sounds like a good list.
A lot of
be on.
fans here
Yes.
right now for Robinhood, most certainly.
Moving on, Morgan Stanley downgrading Las Vegas Sands from overweight to equal weight. Analysts behind that note seeing China GDP limiting outperformance, so not as friendly here on Las Vegas Sands. Takes a more guarded house view on China GDP. That was one reason, thinking that could impact the company. Talks about plateauing trends in Singapore just as capital investment begins, Julie.
Yeah, and tariffs are part of that issue too. Part of the what they say, if they look at what happened in the past with tariffs, it weighed on Macau in particular. That's where Las Vegas Sands, despite the name, is exposed. This note, though, from Stephen Grambling wasn't just limited to Las Vegas Sands. It was sort of a bigger look at the travel industry. And there's other names that he likes. He likes Viking Holdings, that's the river cruise company, Travel and Leisure, and Wynn Resorts. Those are the most preferred picks going into 2025.
Right, so downgrades, but offers you some opportunities as well. Yes. Well, coming up, oil prices pulling back a bit today, but are surging to start this year. We're joined by an analyst on the other side of the break. Break down what to expect for the sector moving forward. Stick around. Much more market domination over time coming right up.
A new year for markets and leaders that power them is upon us, and that means the biggest names in business are about to descend once more to the ski town of Davos, Switzerland. That's where the World Economic Forum will be holding its annual meeting starting January 20th, which coincides with the inauguration of Donald Trump as president. The biggest names in corporate America will lay out their visions and expectations for the new year on everything from navigating the Trump 2.0 economy to markets and AI. The theme of this year's event is collaboration for the intelligent age. And Yahoo Finance will be there on the ground as always, bringing you actionable interviews with top leaders from across industries. Will serve as your trusted guide to one of the most influential market-moving conferences of the year. So be sure to save January 20th on your calendar and tune into Yahoo Finance all week on our Streaming Now section on our homepage, our app, YouTube, DirecTV, and all major streaming platforms. We'll also be taping special episodes of My Opening Bid podcast, which you can find on all major podcast platforms.
There can be a big difference between solving problems in a campaign speech and solving them once you're in office. Donald Trump has already learned that once and may already be hedging on some promises before he re-enters office next week. Joining us now, Yahoo Finance's Ben Worschel, our resident cataloger of these promises. So what have we been hearing thus far about how he's framing some of what he's aiming to accomplish?
Yeah. Hey, Julie. So as you mentioned, this is a thing that happens kind of every 4 years, but it's especially stark with Trump in terms of making promises and making really concrete promises, and then the kind of realities of it. So what I went through for a story was just a few issues that he's already hedged on. He's not even in office yet, because that there could be a precursor of more market central issues. The first one that he's clearly hedged on is inflation. You know, every time during the campaign, every rally, he would talk about how prices were going to come. Not that he was going to slow inflation, he was going to bring it down. I looked at his last rally of the campaign, and the quote was, "The donuts are going to come down, the food is going to come down." 3 weeks later, he did an interview with Time and said, "Oh, it's pretty hard to bring prices down." That's true in Ukraine. He talked about making a single phone call and ending the war in Ukraine. Doge is another big one, where Elon Musk talked about cutting over $2 trillion, and now it's somewhere around $1 trillion. So this is already happening, and it's still 6 days out from his inauguration. And there's still a lot of market central issues that are still open questions. Trade tariffs are a big one for certain. We're still expecting a lot of actions there, but exactly how it masters up with the campaign, as well as taxes.
Thank you, Ben. Appreciate it.
Thanks much.
Well, oil prices are pulling back a bit today, but are surging to start the year. And President-elect Trump is now preparing executive orders aimed at boosting the oil industry and undoing some of the Biden administration's policies, notably EVs. For more, we're bringing in Stephen Schork, principal at the Schork Group. Steve, it's good to see you. So we're hearing some reporting, some trickling out of what we're going to get from the Trump administration on day one. On balance, given what we know right now, is this going to be positive for the oil industry, or is it going to be negative? And I know that's a sort of a different question than whether it's going to be positive for prices or not.
Well, absolutely, Julie. And let's keep in mind that the oil industry, as goes the U.S. economy, goes the U.S. oil and gas industry. So anything positive for this industry as a major catalyst for job growth and economic opportunity begins in the energy market. So clearly, I think what the market is focused on is a return of the Obama era. Let's even take the first Trump administration out of this. Let's go back to the Obama administration, and we read the 2012 DNC platform and how Obama embraced, yes, renewables, of course, but he also embraced oil, he embraced coal, he embraced nuclear, he embraced natural gas. And that is where the focus is really coming back. And that's where the positive expectation with this administration coming back is to go back to what was working prior to 8 years ago. So the expectation is, yes, let's deflate some of the regulatory hurdles that have been placed over the past 4 years, both from a permanent perspective, both from a banking perspective. Let's maintain access to capital, easier to expand projects. Let's lower the hurdles, the regulatory hurdles, the court battles, so forth, which is a general positive, not only for the industry, but of course, what this means for the industry will eventually mean lower oil, lower gas prices, lower energy prices, which is, of course, a boon for the U.S. economy.
Stephen, more immediately, oil slipped today. That's being pinned, Stephen, on the ceasefire talks between Israel and Hamas. Let's say you do get a ceasefire there, Stephen, officially. That would mean what for the price of oil?
Well, we're just, that's, you said, that's what it's being pinned on. We have no idea why oil prices moved higher today. We have no idea why oil prices moved higher yesterday. These are general themes of an ongoing trend in the market. We've been dealing with Hamas-Israel war since October 7th of 2023, and it really has had a de minimis impact on price, on volatility. We have oil tankers that are being shot at, that are being blown up in the Red Sea, and that has had a very immaterial impact on price. So it's really, I really will not blame or pinpoint today's pullback on price because of a potential ceasefire, because there really was no uptick in price because of the war. So there really can't be any pullback for the general impact. So we need to look at more of a holistic market here. And so, yes, perhaps we'll see less volatility in that region, but that volatility is certainly not going away. Of course, what we've really had over the past week, that's really been the catalyst, is the new sanctions that have put on the 11th hour of the Biden administration on Russia and on Iran. And going forward to the Trump administration, I think there certainly is an expectation that those sanctions are even going to become tougher. So I think this is where we're starting to see prices materialize of what the potential opportunity or program going forward, as it were. So going forward into this new year, it is going to be a harder stance on Russia and on China, on China also, but also Iran and Russian oil shipments, which therefore will likely decrease the availability of oil on the global market, which is certainly underpinning prices. And I think the market is trying to price that in, regardless of what happened today. But the general theme over the past 2 weeks, trying to price that in coming in as we transition to the Trump administration.
And so on balance, what does all of this mean for the direction of oil for the next, say, 3 to 6 months?
Coming into this quarter, Julie, so what we had is momentum forward on our forward look at volatility. We came into this quarter of oil, NYMEX WTI crude oil spot market, just under $70 a barrel. We had a midpoint Q1 target of $72 a barrel. Well, now $6 beyond that. Our 50% 50 envelope is oil between $83 and $62. So at $78, we pulled back, yes, a little bit today, but we are closer to that 50% envelope. So what I'm saying here, there's a 50% probability that I'm telling clients that oil will be range bound in between 83 and 62. Given that we are in the high 70s, we are starting to push up against that envelope. So my producer clients who have been reticent to lock in forward production at spot prices, at oil spot prices in this right now, pushing upwards of $80, this is an opportunity that will start to appear to producers to start locking in forward volatility. So we're looking at what I'm expecting oil in the first 3 months of this year, at $73 midpoint, a high 83, a low 62. That's our 50%. And then we get to our 2/3 envelope. We're looking at oil potentially as high as $89 a barrel. But beyond that, yes, can we go higher? Statistically, yes. Realistically, economically, very unlikely. So we're at an opportunity right now for producers that they should be locking in forward production. For consumers, oil prices are high. They're not too high, but wait for a pullback. And let's wait for oil to pull back into the low 70s, which it will at some point over the next 3 months, and take advantage of that opportunity.
You mentioned consumers, Stephen. I'm just curious, what does all that mean for gas prices at the pump?
Yeah, absolutely. So what we're looking at here is historically about every dollar move in wholesale crude oil prices translates into 2 cents at the pump for retail. Right now, gasoline prices are low, especially relative to where they've been for the past 3 years. But let's keep in mind, we are consuming winter grade gasoline. This is a very different blend of gasoline. It's very cheap to manufacture. Therefore, it translates to lower prices at the pump. But as we transition into the second quarter, 2 things happen, right? Demand is going to start to pick up as the weather improves. And we have now blend for a different type of gasoline, which is more expensive to blend. So we'll get about another 20-cent pop over the next 4 months. And that's just absolutely normal. But on an inflation-adjusted basis, given where oil prices are, and if they remain where I expect them to remain, i.e. in that low 70 to high 70, maybe a low 80 range, we're looking at gasoline prices that are going to be very attractive relative to where they've been for the previous 3 years.
Stephen, always good to see you and have you on the show. Thank you so much for joining us.
Great to be here. Thank you.
Time now for What to Watch Wednesday, January 15th, sponsored by Tasty Trade. We're going to start off on the earnings front. Big banks kicking off another earnings season tomorrow. JP Morgan, Citigroup, Wells Fargo, all reporting in the morning. JP Morgan announcing results for its 4th quarter before the opening bell. Analysts expecting net interest income to benefit from higher rates. Investors will also listen closely for any commentary following the company's announcement that COO Daniel Pinto will be stepping down from his position in June.
And taking a look at the economy, we'll be getting a key piece of economic data in the morning with CPI. That's the Consumer Price Index. Economists forecast total CPI will rise 0.1% to 0.4%, while core CPI could hold steady at 0.3%.
And moving over to the Fed, we're going to be getting another batch of Fed commentary from Presidents Tom Barkin, John Williams, and Austin Goolsbee. Wall Street will be looking out for any clues about what the Fed's next move will be with interest rates.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. An up and down day for the markets, with the Dow and the S&P eventually closing in the green, the Nasdaq lower after investors took in the first of two key inflation reports this week, which showed prices rose less than expected in December. We're going to dive into the rest of today's market trends. Then Donald Trump's nominee for Defense Secretary Pete Hegseth facing a contentious confirmation hearing on Capitol Hill today. We're going to recap and take a look at the defense sector's outlook under the incoming Trump administration. Plus, we're going to speak to the CEO of prediction market Kalshi. Donald Trump Jr. is going to be joining that company as an advisor ahead of his father's return to the White House. What it all means for the company, that's straight ahead. Well, as expected, Donald Trump's nominee for Defense Secretary, Pete Hegseth, did face a contentious confirmation hearing today, but also provide hints as to where his focus would lie, and his comments should make the Doge side of the party happy. Take a listen.
We won World War II with 7 four-star generals. Today we have 44 four-star generals. There's an inverse relationship between the size of staffs and victory on the battlefield. We don't need more bureaucracy at the top. We need more warfighters empowered at the bottom. So it's going to be my job, working with those that we hire and those inside the administration, to identify those places where fat can be cut so it can go toward lethality.
And joining us now to react to today's hearing is Christopher Kirchhoff, founder of Pentagon's Silicon Valley office and author of Unit X, How the Pentagon and Silicon Valley Are Transforming the Future of War. Chris, it is good to see you, and you are in fact, Chris, the perfect guy for this. And I want to start here, Chris. If Pete Hegseth is confirmed, and he is our next defense secretary, what does that mean for the Pentagon, Chris? What kind of changes would you expect and want to see?
Well, we're living in an absolutely wild world, from Ukraine to conflict in the Middle East, to the Red Sea, to the rise of China, to sabotage around the world. So there is a widely agreed upon idea that the Pentagon is ripe for transformation, for very fundamental transformation. This is agreed upon in the Congress by President Trump and his staff and the soon-to-be White House, and also by the leadership team he's appointed to lead the Pentagon. So I think big potential things await the new team in terms of what they could do to transform the Pentagon.
There are some folks, Chris, even fans of Hegseth, who say, listen, decorated combat veteran, impressive academic credentials, but they do wonder how much can be meaningfully changed at the Pentagon, because it's just that big an institution, that enormous, and plenty of obviously sharp-elbowed folks over there. How much change can one man actually have, Chris, in your opinion?
You know, Josh, being the Secretary of Defense, it's almost an impossible job. So imagine that you were the CEO of, say, a top 5 Fortune 100 company, except that you weren't able to fire people. You didn't control your own budget. And instead of having a small board of directors, you have 535 members of Congress as your board of directors. This is why public leadership is so hard. There's very little margin for error because you have fewer tools that you need to drive fundamental transformation. So I think that's why there are a lot of questions. Is this the right man for the time, and what will arguably be the most important Secretary of Defense since the Second World War?
Why do you say that, Chris? Why is he that important? Why is the next SecDef that important?
Well, to bring back a Second World War analogy, you know, we were able to win in the Pacific because military innovators in the 1930s figured out that aircraft carriers rather than battleships would carry the day. And we are today facing those same fundamental questions over what sort of operating concepts and weapons platforms to use in all military domains: land, air, sea, space, undersea. So for that reason, the next secretary just faces very fundamental choices about what our force will be in the future. And if they get it wrong, we could see ourselves with a very different military that's far less successful or dominant than the military we have today.
A lot of this will depend, Chris, on whether Congress is a good partner here. Congress, of course, controls the purse strings. Do we have any line of sight of whether that's going to happen?
Well, it's going to take leadership. You know, the last team in the Pentagon, the Biden team, was able to launch a very important new initiative called Replicator, using autonomous drones to fight in new ways. But they were only able to cobble together, even with Congress's support, just over $1 billion worth of funding in an $800 billion budget. So that shows you how hard it could be, even for things that people agree are important. For the Pentagon to make change, you have to stop spending money on things you're buying today. And politically, particularly in the defense sector, that's one of the hardest things to do.
One of Trump's priorities, Chris, is to streamline the government. He's got Musk and Ramaswamy working on that, right? Doge, our new Department of Government Efficiency. If you listen to Hegseth today at the hearings, I mean, it's clear he's on board with that. He thinks there's fat to cut at the Pentagon. You know the Pentagon backwards and forwards, Chris. Do you agree with that?
Well, I think there's two categories of things I hope Doge looks at. One is, are there actually efficiencies that you could wring out of the way the Pentagon does business? And the answer undoubtedly is yes. But you know what? Even if you pinch every penny out of the Pentagon, that will probably pale into comparison to the money that we spend on systems that we know today will be demonstrably unsuccessful were we to go to war. So I think the larger question for Doge and for the incoming secretary is, what ought we not be spending our money on that we have been for years, almost on autopilot, even as the world around us changes so significantly?
Finally, Chris, Hegseth is a critic, and he seems to echo Trump's criticisms here that at the Pentagon, they seem to argue, listen, they're valuing diversity and wokeness, as they put it, over warfighting, over military effectiveness. As somebody who knows the Pentagon, is that a fair criticism, Chris, based on your experience?
Well, look, we're having a national conversation about these issues that is broader than just national security. So it's not surprising in a way that we're seeing this discussed in relation to the Pentagon today. But what I know of our men and women in uniform, if we get lethality wrong, they are the first to pay the price. So they are very dedicated to making our military the best and most lethal institution it can be. And I'd say further that, a Secretary of Defense, they really only get to choose to do one or two or three things, three big things. There's only so much oxygen in the room. There's only so many hours of the day. And so the incoming team is going to have to make choices about what to them is the most important objective to pursue. And for me, that would unquestionably be an enormous technological upgrade for our military.
Chris, great to see you. Great to have you on the show. Thank you for joining us.
Thanks, Josh.
Well, in this week's episode of Decoding Retirement, host Robert Powell speaks with Lori Rowley, Icon Savings Plan founder and CEO, about how the modern workforce can find solutions to the retirement crisis. You can scan the QR code below to stay up to date with the latest episodes, and be sure to watch Decoding Retirement every Tuesday at noon Eastern. Here's a clip from today's episode.
When you look at other countries, what is it that others are doing who earned like an A grade that we ought to be looking at to incorporate here in the U.S.? Any thoughts about that?
Yeah, I mean, I have thoughts on that. There's two big components of that. So they have more sort of national mandates. So we have state by state, we have this patchwork of state retirement plans, which also is putting a huge burden on employers that have employees in multiple states, but that's a different topic. So I think if we had a national mandate, that would put the United States more in line with some of those other countries that get higher grades. The other component is what to do with that money once you've saved it in retirement and how to live on that money. And so a lot of other countries have programs that help people figure out how to live on that savings that they have acquired through their lifetime. And that's where our system really falls short. There's a whole bunch of reasons why. I'm sure you've done multiple podcasts on that topic of retirement income. It's a challenge that we have in our country. Part of it is because of the 401k system and how that doesn't really interface well with the retirement income system. But again, as we're looking for retirement 3.0, I think part of it has to be more personalized, easy to use options on the living on your money in retirement component of the equation, which we haven't solved that at all in our country. It's a huge problem.
Yeah. I mean, when you look at countries like Australia, where they have a superannuation program, or maybe the United Kingdom, where they have the Nest program, are those things that you think would be worth adding to our sort of mix of solutions?
I mean, we're talking about, I think it's good. There's been enough years of saving under those plans to look at what's really worked and what hasn't, because they have problems too, frankly. And so I think we have an opportunity to learn from those countries and see what they've done that's worked for them, and maybe come up with a hybrid system. I wouldn't say we should exactly copy some of those other systems, but having dug into the data there, I think there's a lot to learn and a lot of good takeaways that we can sort of build on for a national retirement policy that works for businesses and employees.
Well, U.S. stocks close mixed as investors digest inflation data and potential Trump tariffs. And Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. We got bank earnings tomorrow, big banks, but guess what? Regional banks were leading today. And let's just take a look at some of the mix of bank results from the day's price action. This is our leaderboard, but we want to go to financials. So we're going to find that on our second page, I believe. There we go. Here's our big banks. We're going to see JP Morgan tomorrow, and you can see fine day here for the biggest bank as well as some of the smaller ones. We got JPM, Bank America over 1%, so is Goldman Sachs. And if we take a look at the regional banks here and see if I can find those have been perking up as well. And as I was saying, they have kind of led the pack today. It looks like I might not be able to locate them. Oh, they're right next to the big banks right there the whole time. And you can see some of these are sporting some nice gains. CFG up 3.5%, Wall up 4.5%, and the list goes on. But there's been a lot of stuff happening, not only with the dollar, but rates, and that's just kind of been a big
rates. Yes, I mean, we've been talking a lot and for good reason about the 10-year.
Yes. And you know what? I just sat down with Jay Woods of Freedom Capital Management on the latest episode of Stocks in Translation. He had some interesting things to say about the Trump trade, and let's take a listen.
For me, the most interesting sector with the Trump trade, financials, regional banks, mergers and acquisitions, and then the leaders, the JP Morgans, the Goldmans, the Berkshire Hathaways of the world. They'll continue to do well and excel in this kind of environment. The X factor to me, that 10-year yield.
Ooh, there you have it, that 10-year yield. So that's what we're going to be focused on right now. Kind of related, does it? It leads to our number 2, VIX, SHMIX, because that's volatility. That's the volatility that we've been seeing in the market as a result of some of these higher dollar cross pairs that we've been seeing, and also some of the rates that have been just shooting skywards here. So let's get a look at the VIX. Here we have over the last 3 months. We can see this big spike here was December, and I'm going to show you a 1-year look, just show you what we were coming off of, because 22 emerged as an important resistance level. You can see it was exceeded a few times. This was Yen-mageddon in early August. This was that Fed meeting, that hawkish surprise by Jay Powell in mid-December. But for the most part, this was containing the VIX, that 22 level. So now I want to go back and I want to show you our map for the coming year. This is the average of VIX price levels going back to 1990. So now we have about 25 years of price history here. So this shows you how the VIX tends to evolve on average every year. And you can see right now, so we're right here, we're seeing a little bit of a spike maybe into early February. And remember, we got lots of catalysts on the horizon with the new president, a little bit of a dip there, peaks into March, and then a decline into the summer doldrums, but then it ratchets higher, and it ratchets higher all the way into primetime crash season when we see the VIX a lot of times spike in October, sometimes November as well. Then it quiets, it zigzags down into the new year, and then we get potentially that Santa Claus rally, that low volatility rally that carries over into the beginning of the year once again. So to just clear things up, it looks like we're heading into a potential area of more volatility in the early spring, and we do often get a pullback, not as big as some of these later in the year, but a little bit of a pullback there potentially.
All right, Blickery, point number 3.
Let's go for it here. We got Bitcoin leading stocks. Josh, you and I have been tracking this head and shoulder pattern in the S&P 500, also in Bitcoin. I'm going to put a 3-month chart with some candlesticks here so we can see how this has evolved. I'm going to draw this one more time. Left shoulder, head, right shoulder. And guess what? This is a neckline right where this dotted line is by coincidence. We closed below it 3 days ago. And then today we closed below it again today. In the middle, we had a little bit of an up day there, but that's 3 closes in a row right around, right below the Rubicon. So that gives me a little bit of a bearish bias here. But what's tempering that is if I take a look at Bitcoin here, and we can see a little bit more bullish. So to trace this out, left shoulder, head, right shoulder. All right, and then yesterday we got that dip below to 89,000 and change, and then we rocketed right back above. We're at 96,000. So this is already resolved to the upside, and that's why I'm asking the question, is Bitcoin leading? Is Bitcoin going to point the rate to higher risk assets? We're just going to have to see. CPI, big banks tomorrow.
How important CPI tomorrow for the markets?
Incredibly important.
Incredibly important.
Incredibly. That ties into the 10-year T-note yield. So we will be watching that closely.
Thank you, buddy.
You bet.
Appreciate it. Kalshi makes a big move to bring in Donald Trump Jr. as a strategic advisor. The prediction market company highlighting how this collaboration signals a new era for event trading. And here with more is Kalshi CEO Tarek Mansour. Tarek, it is good to see you. So let's start right on that news, Tarek. How does something like this come about? I'm just curious. Do you call Don Jr.? Tarek, does he call you? Walk us through it.
Well, first of all, thanks for having me. Really excited to be on the show. I think that the thing that's interesting that happened the last few months, as you probably have seen, prediction markets have gone from this sort of niche corner of the internet where a bunch of really strong, sort of really deeply committed customers and fanatics believe in the power of these markets to basically going fully mainstream. Thanks to the last election. And, there was kind of this sort of vindication of prediction markets that they were actually right, and people have understood the social utility of these markets. And Kalshi was central to that. Kalshi was a central part of the discussion around elections, and now Kalshi has become a central part of the discussion around really any question about the future. Who's going to be confirmed, what's going to happen at the inauguration. We currently have 983 markets that people are engaging with. Who's going to be at Trump's inauguration? Will AOC show up? What is he going to say? What types of policies is going to enact in the first 100 days? Who Biden is going to pardon, and so on. And so that visibility has basically gotten us there. And we're really, really excited about the announcement yesterday.
And so Don Jr. brings what, Tarek?
So Don Jr. has been a big proponent and super vocal, really over the last decade or so, about the idea of speaking directly to the American people. And I think the one thing that he's incredibly good at is doing exactly that. And he's very attuned with what the American people want and feel, which I think is extremely important as we are thinking about how to really aggressively expand Kalshi and its user base, but also as we look to educate people about prediction markets and how they can be used to further society's interests and American interests. So that's really kind of the core of the role. And really the way I see it is there's this kind of merger that's happening where people are kind of firing traditional media, traditional pollsters, and going to Twitter for news about the past and going to prediction markets like Kalshi for news about the future. So really excited about what's to come in 2025.
And Tarek, are there regulatory changes in Washington that you'd like to see that would benefit your company, the space you operate in, that you think perhaps Don Jr. could help with?
It really hasn't really come to us. I don't think that there's kind of the way I would put it is we are extremely excited about the idea that people now finally understand the power of prediction markets. It was something that we were screaming off the top of our lungs over the last few years, and it was true. Forecasted the inflation better than anyone. We forecasted things like earthquake better than anyone, the weather, climate, and so on. But the election was this moment that kind of slapped everybody and told them hey, everyone, prediction markets actually do work. Look to Kalshi for your news and stop looking for polls or even traditional media. And I think this opens up, a really interesting avenue for us to really aggressively push the envelope on these markets in 2025.
And post-election, Tarek, I'm curious, what are people betting on the most right now? What are the topics, trends, themes that are top of mind for folks?
It's really all across the board: politics, culture, entertainment, weather, climate, financial. So right now, leading into the inauguration, actually just now, there was the Secretary of Defense confirmation hearing, and people were, trading and betting on what's going to happen and his odds. And actually, his odds shot up from 76% to 90% from pre to post the hearing. And then inauguration, will Zuckerberg show up to the inauguration? Who's going to speak? How many people will attend, which has actually been a really large market on Kalshi. What are the first policies that are going to be enacted? Are we going to have mass deportations? Are we going to see big government cuts from Doge? And really 983 markets live on Kalshi, and that number is probably going to double in the next month or so.
Tarek, great as always to have you on the show. Thanks so much for joining us today. Appreciate your time.
Thanks for having me.
Coming up, we're looking at the impact of the U.S. dollar on gains in the S&P 500 in our chart of the day. More asking for a trend right on the other side. For our chart of the day, we're looking at the long-run trajectory of the U.S. dollar and its impact on performance in the S&P 500. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
This chart coming to us via Julian Emanuel of Evercore ISI, and he is trying to suss out the strength in the U.S. dollar and whether it is going to weigh on stock returns here in the U.S. and weigh on earnings and then stock returns, I should say. And he looks at history since the great financial crisis and shows the trade-weighted U.S. dollar, shown here in the sort of amber color, hasn't done much to dampen the enthusiasm for stocks globally and for here in the U.S. Here's the MSCI World Index, which is up, but the S&P 500, of course, has outperformed it by quite a bit. Now, a cynic, I was talking to our Josh Schaefer about this chart. Someone might say, well, you can put up most assets versus U.S. stocks since the great financial crisis, and it would have done better. Stocks would have done better. But nonetheless, this does show that the U.S. dollar strength hasn't really put much of a curb on things. Will it going forward? Well, Julian looks at things like what we're hearing from companies on conference calls. Are they more talking about the negative impact of FX? Also, he talks about that 32% of the S&P 500 revenue is international, 30% for the Russell 3000. And when that revenue is coming back to the United States, it's worth more. So there are advantages, of course, to having that strong dollar. So it's kind of a TBD and seemingly here in terms of what investors are going to determine, as he said, when a strong U.S. dollar is too strong. So I guess watch this space is the takeaway, even though the chart has shown it didn't provide much of a headwind.
All right. Thank you, Julie. And that is wrap on today's Ask for a Trend. Have a great night.